We are 4 years into our 25-year prediction. We're at 15%. And when you look at the platforms that are actually in the S&P 500, they've been around forever, right? We're not even counting all of the platforms that have just come public in the past year or two. These companies have yet to really turn on the profit engine. The platform economy. There are 70 public platform stocks. That's globally. But in our previous episode, we were starting to look at, there are 21 public platform stocks that are in Platt, the ETF, that are also in the S&P 500.
Right. Those 70 stocks that you mentioned globally, there are 70 stocks, 2 billion in market cap or greater, that are listed in the US and Europe.
21 of the 70 are in the S&P 500.
Right.
The newer companies that are IPOing now, they literally just can't be in the S&P 500.
Right. It takes a couple of years to get there.
But over half of the 70 public platform stocks today literally weren't public 5+ years ago. So these things are so new and they have such growth in front of them. But what we wanted to do is take a look at the earnings dynamics here. So if we look at all of the S&P 500 stocks, quarterly net income, right? So aggregate net income earnings for, now this is looking at Q1 here, you can see. So Q1 blue line is at about $316 billion. This aggregate net income across all of the 500 companies in the S&P 500 for Q1 of 2019. Now, the interesting thing is that then when we compare the 21 platform stocks,
just under 5% of the S&P 500.
Just under 5% of the companies in the S&P 500, and the earnings that they have, basically what the calculations come out to, it's a little over $43 billion. Now, this is actually the data from the most recent quarter, so technically from Q2. So it's not exactly apples to apples, but you get the point, right? You have roughly $40 billion in aggregate earnings from the 21 public platform stocks in the S&P 500, which, do the simple math, $316, $43 billion. It's let's call it 15%, roughly, 7th and 8th, somewhere around there. That if you have a little less than 5% of the companies accounting for around 15% of the earnings. I mean, I think that is just one small example of the earnings potential and the growth potential of platform businesses and how new they are. I mean, look at these platform companies that are in the S&P 500, by the way. And if we were to look at founding dates and IPO dates, you have companies like Copart in here. Copart has been around for decades. eBay, Expedia, Salesforce, Google, ICE, so they own the New York Stock Exchange.
Yeah.
MasterCard, Market Access. They just are joining the S&P 500. That was just announced in the past week or so. NASDAQ, PayPal, TripAdvisor, Twitter, Visa. Really, none of these companies are new. Maybe Market Access is probably the newest company. Facebook's in there. CME Group. These are both CBOE Global. These are investment platforms that have been around for ages. Booking.com, Amex, Amazon, Apple. They're not new companies, right? And I think what we predicted June of 2015, pre the book coming out. Book came out May 2016. This was while we were really building a lot of the research for the book. What we said is in 25 years, 50% of the S&P 500's net income will come from platforms. I'd say we're entirely on trend for that. We are 4 years into our 25-year prediction. We're at 15%. And when you look at the platforms that are actually in the S&P 500, they've been around forever, right? We're not even counting all of the platforms that have just come public in the past year or two.
Yep,
which
you've got at least half a dozen, I would say, that'll be candidates for it within the next few years.
Right. And that's really the growth cycle, that even though you have SoftBank, even though you have these mega VC deals that are essentially pushing out the date that they go public, and also really those mega VC deals are, I think, part and parcel as to why companies like a Slack can do a direct listing, and they don't really need the capital,
Yep.
but really they're just trying to get the liquidity. It's good for their employees,
investors,
their investors. And it just makes them a stronger company. It gives them more liquidity. They can get debt more easily, all these kinds of things. It just makes the actual strength of the company much better. So it makes sense. But even with the fact that companies are necessarily going public later on in their life cycle, and then they are able to burn through cash a lot more aggressively than say an Amazon could have when it was getting off the ground. These companies have yet to really turn on the profit engine. They're still really in heavy growth mode, and they haven't really gotten to the point where they say, I'm going to turn my monopoly, their monopolies, into a cash cow and really start turning on the profit. I mean, look at an Uber, look at any of the companies that have really started to go public recently. Eventually, Uber and all these companies are going to get there, especially the ones in the number one.
Maybe not all of them.
Yes, especially the ones that what I would say is in the number one spot. And Uber in the number one spot. I think a Lyft is going to have a much harder time. A Pinterest, which I think really owns its own niche very nicely.
Yeah.
And there's competition, but it's not. It's maybe overlapping. It's not as direct.